In this video, we are going to cover business finance fundamentals. Basically, what are the terms that you're going to encounter as a business owner? I know, finance is, it can be a bit intimidating, especially for um, uh, SME owners, startup founders, startup entrepreneurs. But this video is going to be a deep dive in terminologies that you will see on your journey to running and building and scaling a business, because there are some terms that investors are going to throw around, and as a founder you might be intimidated. So I want you to come back always to this video and remind yourself, what are these terms. I'm 100% sure that there are some terms that you've heard maybe in a conversation. It could be a partner that was mentioning it. It could be your team member, your accountant, your CFO that mentioned it, and you were not able to properly capture what are those terms, what do they mean, and where do they fit in my business. So this video is going to go deeper into those terms and actually I'll also attempt to show you how they apply to your business. You will see some finance terms, but also some finance tactical strategies that we use in business that you're going to also learn. So this is going to be potentially a long video. If it's too long, I might have to do a part one and part two, but I want to go all the way. So without going further ado, let's do a deep dive into the content. So I'm going to go ahead and share my screen and we get started. Right. So this is fundamentals of business finance. It's a classic finance for business owners, basically. So this is a screenshot for one of the tools. I think I mentioned it in the previous video, or a tool that we use when we are consulting businesses called the Enterprise Growth Infrastructure. Basically, it's a tool that allows us to help you solve problems in your business, but also turn those solutions and new strategies that we have into actual solutions or processes for your business. Now, finance is quite easy to understand if you focus on what is the most important. This is the baseline, or the idea that I want you to carry alongside this video. So there is no, because finance is its own space, just like you can say, medicine, engineering, finance has its own linguistics. So because it's most of the time it's numbers. So some of the terms that you're going to see are how we call a situation in finance language, okay? In the language of finance. So don't think it's complicated. It's very easy. We just have to understand what are those concepts and actually learn how to use them and see how they fit in business. Again, the purpose here is to help you be conversant when you're speaking to your accountant, when you're speaking to a CFO, when you're having a conversation with your investors, to know exactly, what do they mean by, a certain term, and how can you actually interpret that properly in your business or in the concept of your business. Now, so what is finance? So finance is the art and science of watching the money flowing into and out of the business, then deciding whether or not it's enough to keep going. So that's what finance is all about. So it's basically interpreting the flow of money in and out, okay, in your business. Now I'm going to be very quick. So I want you to, stick with me. And by the way, also, if you have a question, drop it in the comment. If there is a topic that you want me to cover on this YouTube channel, I'm very open to doing a video on that as well. So I'm also in the process of uh, learning what you need and sharing, because most of what I share here are what I've acquired, the experience I've acquired over, a decade of experience working with business owners. But I'm always open to learning. I'm always open to knowing what you need so that I can serve you better. So accounting is the process of ensuring that the data you use to make financial decisions is complete and accurate all the time. So accounting is now, the numbers aspect of the finance of your business. Again, you will see the terms of how we call some situations when money flows in, flows out, flows in without a product or product bought on. And that, how do you call that? It's all about, it's a language. What you need to understand is just a language, and we are trying to put terms, proper terms that a financier can understand on these situations in your business. So finance concepts, every business owner must know. Number one is profit. So profit means bringing in more money than you spend. So it's basically, what you earned minus what you spent on that. The remaining, that's what profit is. Most of us know what profit is. So profit margin is often abbreviated to margin and measured in percentage, is a measure of how much you keep of the revenue you collect from the sale. So it's usually they put it in a percentage. That's why they call it a margin, but it's the percentage version of the profit that you basically you earned in your business. And I think this is a pretty common metric that everyone knows. So value capture. So value capture means keeping a portion of the value created every time someone buys or uses your product or service. If you take too much, people might find that your offer less appealing. And this is what usually happens. And I think that's what makes cultures like Chinese, okay, great and excellent traders, because they understand that value capture should not be a burden to the buyer. So you should not, the purpose is not to maximize profit. The purpose is to make enough that you keep going. This is something that people need to also, especially if you're a business owner and you're trying to set your pricing. We'll see pricing, how do you set prices, either in this video or the next ones. But also I believe I did a video on pricing, how to do proper pricing for your business. But essentially what you are trying to understand is, by value capture, what I want you to understand is, it's essentially a way of pricing in such a way that you collect what you need enough to keep going. You don't want to maximize, because if you maximize, then people or your customers are going to feel like you are putting a burden on them. So what you want is to have them feel like they actually got a good deal. Okay, so the value was as high as it can be, but also the price was as low as comfortable, so that each and every party has the reason. So the customer has a reason to come back and buy from you, but you also have a good reason to keep going. You are incentivized enough to keep going. So there are two main ways to do this. Number one, maximization. So keep as much value as you can. Minimization, keep only as much value you need to stay sustainable, so your offer stays as attractive as possible. So again, there's always options. So you can choose to maximize, which comes with its own cost, or you can choose to minimize and, capture enough so that you keep going. So value capture is a balancing act. You need to earn enough value to make your time and effort worthwhile, but not so much that customers no longer see as a good reason to choose you. Now, 5 is sufficiency. Financial sufficiency is when a business earns enough profit to make it worth continuing in the long run. Once you reach this point, you're successful, no matter how much money you actually make. So, financial sufficiency is when a business reaches a point where, this is how I define financial sufficiency. This is when a business can pay the employees their salaries. As the CEO or as the founder, you also have your own salary. That salary can cover your bills. It can help you be a responsible citizen. So it means you're paying bills, you're obeying your responsibilities. If you're married, if you're single, doesn't matter. But it can sustain you. The salary can sustain you. The business sustains the employees, and you still have money in the bank account that can cover the bills of and the business bills are also covered. So that's what financial sufficiency is. Now, businesses, very few businesses actually reaches here. And the reason is, I would actually say that two main reasons why that doesn't happen. The reason why it doesn't happen is because most businesses die at, in infancy. And that is because sometimes, the problem that is being solved is not existing, or the solution being provided is not the right solution. So there is a mismatch between the problem and the solution. So it doesn't match. Another reason why businesses don't reach sufficiency, it's also it could be an operational problem. An operational problem being that, so to reach financial sufficiency, you have to have a level of systems in your business. And these systems are the ones that are going to help you scale to the level where you can reach financial sufficiency. And these systems are systems that are processes that your employees follow to service customers, to create value, to market, to grow the business. But if the systems are non-existing, you will find that most founders are actually not at a level where the business can pay them a salary. They rather take money from the business, and that's the money they use to support themselves. There's nothing wrong with that. Like I always say, that's a phase for your business. The only thing you have to do as a founder is to always be aware that's not what your business is and should be. The goal should be to get past that, and that chasm that most businesses have to go through. Some of them fall in the chasm, or others cross it. But that's once you cross that chasm, you've reached what I call escape velocity. So escape velocity is when a business reaches a level where it can now it escapes those first few years of that usually kills businesses, more like babies. Also, there's also some age sometimes for kids or babies. It's usually 5. When a kid survives the first 5 years, or even the first year, sometimes they have escape velocity, the mortality rate or probability drops significantly. So it's similar to businesses. And usually businesses are not killed because they don't have systems. They are killed because they don't have customers coming in, which also it's a chicken and egg type of situation. Because also, once you have validated the product, you should go back to building these systems so that you can actually reach financial sufficiency fully. Okay, so that's what financial sufficiency is. Valuation is an informed estimate of a company's total worth. So this is a metric that most investors are going to ask you. They will ask you, so what is your company valuation? And I'm sure if you're watching this video, you've heard that. If you're familiar with the startup space, you've been asked probably this question. So valuation can go up when it earns more revenue, has strong profit margin, keeps a healthy bank balance, and looks promising for the future. The higher its valuation, the easier it is to borrow money, and the higher its share price, the more it could sell for if acquired. So valuation is also crucial when bringing in investors. So the higher the valuation, the more money you can raise for each share that you sell. This is for companies that are either public or are offering corporate bonds. And usually valuation, they sometimes take the gross profit of the company times 10, times 100, depending on different factors. There are specific professionals who are expert at company valuation, especially if your business is about to raise money. You can hire someone to do evaluate your company valuation and then put a number on it. So it happens, and this is something that you will encounter on your journey to building and scaling business, and also on your journey to raise capital. This is a question that you're going to be asked, so it has to be in your at the back of your mind, even if you're starting. Okay. So cash flow statement. So this is, you've heard this term. It's an examination of a company's bank account over a certain period of time. So think of it like a checking account ledger. So deposits, cash flow in, and withdrawals of cash flow out. Ideally, more money flows in than flows out, and the total never goes below zero. So it's a cash flow statement. So it shows how the money flows in and out of your business. Income statement. It's a financial report that shows whether a business is making profit. Business carries inventory or offers credit to customers. Looking at cash flow alone can give a misleading picture. So to truly know if your sales are profitable, you need to connect each sale to the expense that went into making that sale. By matching revenue with the related cost, you can see whether you are actually earning a profit. And this is where accounting and finance becomes, a critical aspect of scaling your business. One of the areas we work on when we're building SOPs for businesses, for when my company is building SOPs for businesses, is the finance department. And in the finance department, we build a systems, a collection of processes that actually allows the entrepreneur to track real time what is happening in the business. We do that through, of course, having the processes in place, but also integrating software in your day-to-day processes. So that way, that this income statement, what is happening. Let's say, because sometimes a client might pay you $5,000, but you have two clients, both they paid you $5,000, but one client, they have cost you 3,000, whereas in a normal situation, usually they cost you $500. So that is a special case, and that's actually why you should, also look at income statement. And also, it also affords you an opportunity to solve issues before they become problems. So basically what you're doing is you're tracking real time the data of your company, what is happening, what's going on, and then you can, make real time decisions when you're running a business. So this is a very important aspect of the work that we do when we are consulting business. But by the way, I'm going to attach in the description of the video, I'll put a link if you want to book a one-on-one session with me, consultation session with me, so that we can go through the situation of your business, get to understand what is happening and what can we do about it. Because usually the approach is, once you book the 1 hour consultation session, so what we do, we send you what we call a business maturity assessment quiz that you take, and then goes through the questions about your business to assess how is the business doing, and then it compiles a report that has percentages on how your business is doing. And after that, we actually get to decide the best way forward. Are we going to which department are we going to start with? So we solve the problem. So we start with collecting the data, we put together a strategy, we bring in technology, and then we document and systemize the whole solution that we've given you, so that it becomes an asset for your business that you can go ahead and use anytime. So it's really a wholesome solution for your business. So balance sheet. So this is a snapshot of what a business owns and what it owes at a specific point in time. So the balance sheet are useful because they reveal key details about a company's financial health. So by looking at a balance sheet, you can tell if the business is solvent, whether it's still struggling to pay its bills, or how its overall value is changing over time. So that's what balance sheet does. So it shows you what you own. It shows you what you owe others. So assets, liabilities, and owner's equity. Now, so financial ratios are beneficial because they allow you to make comparison very quickly. So financial ratios are useful for, let's see if I think I have, so this is, no, this is not an example of financial ratios, but I wanted to show you how financial ratios look, but it's okay. So they're useful to assess sanity for a business. and efficiency without spending too much time. So every business has a small number of important ratios to consider. So it's worthwhile to do a bit of research to see what are they for your industry. So financial ratios are they're industry specific and sector specific. So depending on your sector, you can ask your accountant, is there some financial ratios that I should know? Or you can do research and know what are those financial ratios that applies to your industry. So cost benefit analysis. So cost benefit analysis is the process of looking at a potential business change to see if the benefit outweighs the cost. So this is that analysis that you do before jumping on an opportunity. So it's important to include both financial and non-financial factors before deciding. Look at all the costs and benefits together. So if the results don't help you make improvements, that makes your move, your business forward, the analysis isn't worth doing. So again, the goal of the video is terminologies, so that when they talk about it, you know exactly, you can know what do those terms mean. If you're about to go into a business or an opportunity, and a consultant said, we need to do a cost benefit analysis. You need to know what are those cost benefit analysis. What is it? So there are 4 methods to actually increase revenue. And, this is a video about finance terminologies, but also finance in general in your business, okay, as a department. So there are 4 ways. So you can increase the number of customers. You can increase the average transaction size, okay? Or you can increase the frequency of transaction per customers, or you can raise your prices. Now, most of business owners, they only think of number 1 and number 4. They don't think about number 2 and number 3. And actually, companies like Netflix, I'll give you an example. They don't make a lot of money on new customers, new subscribers per month. They make money on recurring transactions. When you say frequency of transactions, this is when you lock in a customer and you have designed products and services that allows them to keep coming and coming and coming and coming. And this is where the subscription model comes in, okay? This is when, and this, by the way, this applies to anywhere. There is a, beautiful business that I recently saw in Kigali called Fresh Eggs Kigali. I'm doing marketing for them. So where you do subscription for eggs delivery. So instead of always, sometimes you go to the fridge, there are no eggs, and you're about to make breakfast. So for Fresh Eggs Kigali, what they do, you pay subscription, and then they bring the eggs, and then you pay, and you don't worry about running out of eggs. That is an example of a brick and mortar business, what we call usually boring businesses that have applied this method of increasing revenue, which is increasing the transaction, the frequency of transaction. Now, average transaction size, you can also do the same. It's also similar. If you're running a business, you can have a way of offering more value to the customer, so that they move from spending $20 with you all the way to spending $200 with you, because you've increased the transaction size. And I've seen this in retail, I've seen this in service, I've seen this in SaaS, I've seen this in actually even software business, SaaS, as I was saying, whereby, for instance, for Zoom subscription, or they incentivize you to actually buy more. Let's say if the subscription per month was $15 per month, now, if you pay monthly, you pay 15. If you pay annually, you pay 13. That's increasing the average transaction size. And that 13 is billed right away. 12 months, they take 12 months right away. That is a way of pricing. And that's how you increase. That's one way to increase revenue in the business. So I would say that, again, this also ties in the previous video that I recorded recently, where I was talking about how when we think of scaling a business, people think of increasing the number of products that you sell, the products that you sell, bring in more products. No, sometimes it's actually improving the customer experience. Sometimes it's changing how you package them. Sometimes it's adding more ways customers can interact with your business more instead of a one-time thing. You were, let's say you are a technician and you repair cars, or you have a car washing business. If the only way I can have access to, if the only service you provide is me bringing my car, you wash it, I pay, and then I leave, then you're leaving money on the table. You should have other ways that you can get money out of me, other ways that I can enjoy the services of your company. Could be, you can pay subscription, and if you pay, let's say 12 times 12, for 12 months, you're going to get a month for free, or 2 months for free, or 3 months for free, or 4 months for free. You can also add other services such as repairing, such as accessories, such as dropping off the car after washing it. So all of those are ways that complement the products or the service that you're offering without changing the core product. So it's all about being innovative and seeing a customer as someone you want to take care of, and find creative ways to take care of your customers and make your customers' life easier through that, removing any form of friction. And this is what we discussed in the previous video where I talked about value stream. And the whole purpose of talking about value stream is to reduce friction in the way people experience your business or your services. So the more you reduce these frictions, the more you reduce these sort of hurdles to access your products and services, the more easier it becomes for people to buy from you. So the next time you think of scaling your business, don't always think of bringing new products or new services. No, find a way you can take that product and package it differently and offer it in a different way, in a different context, at a different cost that is going to compensate you and the buyer. Okay, it's all about being creative when it comes to serving and making your customers' life easy. Because remember, at the baseline of every business is problem solving. And really, problem solving is being so close to the customer's needs that you not only solve the problems that they currently have, but you also anticipate future challenges. Okay, and once you are at that level of closeness with the customer, then it becomes very easy to scale the business, essentially, to scale the business, to grow as a business, but also to build incredible relationship between you and the customer and everyone who interacts with your business. So the other term that is very important is pricing power. So this is your ability to raise your prices over time. So the less value you capture, the greater your pricing power. It's related to the economic concept called price elasticity. How sensitive are your customers to price variations? The higher the prices you can command, the more reliably you will be able to collect sufficient profit to remain in operation. Again, this comes down to customer loyalty. If you take care of your customers for a very long time and they have built trust with you, when you raise prices, they will say, he's raising prices so that he can be able to continue to take care of us. And that should be your motive. You should, businesses that don't genuinely care about their customers, they don't scale. And that it's reflected at every level actually of the marketplace. Even if you are employed somewhere at a company, if you don't care about the job that you do, there's a principle that has always guided my career decisions. If I stop caring about the job that I'm doing, I'm out of that company. I don't do things that I don't care about. I don't pay attention to things I don't care about, because the only way for me to do great work is for me to care. I have to care about the problem. I have to care about you. I have to care about the things that I'm involved in for me to deliver at, for me to even touch them. If I'm not, if I'm not interested enough to care, I'm not touching it. This is why I don't work. If you interact with my services, you might say, oh, the prices are slightly higher. Of course, because I will take care of you. I want to take care of you. And to do that, I need to be incentivized enough that I will wake up in the morning looking for ways I can improve your business. So I'm like a second brain for your business. I'm your second brain. Okay. So that's why I command the prices that I command, because I don't want to be in a position where I do work, but you don't feel cared for. So as a business, pricing power is very critical, because the way you build that is building customer loyalty over time. Customers get to say, this is our guy. We will do everything, we'll pay. Because again, remember, humans are feelers. And I remember, this is a true story. So a friend of mine sent me tickets to go watch the World Cup final game at a nice place, and I read, and I saw the tickets. I called her, I said, what, tickets are so expensive. We'll watch it in a local bar somewhere. So first of all, that decision cost us almost the same amount as those tickets that I was calling expensive. And I sat there wondering, and I was saying, oh my God, we should have actually gone to, this nicer place but have a good experience. So the way that experience made me feel, I actually said, what, I would have not cared to spend extra X amount of money to actually go, leave home, go there with tickets, and then sit and enjoy the match without jumping from one place to other because the places were full. So the point I'm trying to make is people are willing to pay premium prices for a premium experience. That's why luxury companies don't run out of money. They don't go out of business, despite charging insane, obscene amount of money. I was watching reading an article on some tickets in the World Cup final at the MetLife Stadium. The cheapest ticket was $7,000. And that is, you're sitting somewhere, it's better to watch it on TV. It's so far from the pitch that, the players look this small. The stadium, 82,000 people, I believe, packed to the max, fully packed. And then other tickets were 17,000, 25,000, 50,000. And there's this other video to complement this idea that I watched. And there were these influencers who were asking folks outside the stadium, how much did you spend to watch during this World Cup? $90,000, $30,000, $50,000. And I'm like, wow, quite interesting. People have money and they're willing to spend it for an experience that will make them feel good. So if you make people feel good, if you make customers feel cared for, they will do and pay anything for you to experience that. So the only thing you have to do is to be obsessed on how can I make your life easier? How can I make the life of my customers easier? How can I make this experience, the way they experience my businesses, how can I make that experience more seamless and more easier? So that's what you should aim for as any business owner. Okay. And then this brings me back to lifetime value. So uh, lifetime value is the total amount a customer is worth to your business over the entire time they buy from you. The more often they purchase and the longer they stay, the greater their value. So the higher LTV, the more you can justify spending to attract new customers and keep them satisfied. So it's impossible to have a higher lifetime value for your customers if they don't feel cared for. Because the only way I keep coming is when I'm happy with the services. So you sell me one thing, I say, oh, by the way, don't you sell this? I came to buy, let's say, socks. It's a clothing store. I'm here to buy socks, okay? Or a suit. Let's say I'm here to buy a suit. And then all of a sudden I'm like, oh, you know what? Actually, so you service me the suit, I love it. And then I say, oh, you know what? I actually think I should get some socks. You give me the socks, amazing. They fit so well, they fit great. And I'm like, you know what? Don't you sell ties? Of course we do. Oh my, this is really good. And you're like, okay, do you also sell shirts? You get the shirts. And then all of a sudden, I start saying, you know, I actually buy a suit every 3 to 4 months. Can I get a discount? And you're, of course, you can actually get a subscription, and we can always bring you new items as we launch them, and then you get a small discount. We repair clothes, we adjust them. If you lose weight, if you gain weight, we are happy to readjust because these are ironed clothes. So lifetime value. So you have to treat a customer or a potential client as a friend that you're going to build a relationship with over a period of time. Okay. And that is a friendship or a relationship. That's why we call customer relations, that is going to last longer. And that what it actually entails is I will keep making your life easier in this department. It could be healthcare, it could be fashion, it could be entertainment, it could be fitness, it could be uh, education, mentorship, anything spiritual as well. This also applies to people who run organizations such as churches and everything. That there is that, okay. And by the way, churches actually have mastered the lifetime value concept, because you come for a church service, they're like, oh, you know what? There is a guest room there. Just go there and then meet people. And then all of a sudden, that's how they recruit you. They invite you for the next Sunday. They give you drinks. They treat you well. And then the next time you're paying your tithe there. Not there is anything wrong with that, but you're paying tithe there, you're supporting projects, you become a member, you join the choir, you start volunteering. So you came as a guest, but now look at you, you are a staff of the church and they're not paying you for it. That's because how you made them feel. The reason why churches are successful is because they have mastered making people feel good and valued. The moment you walk in, someone greets you. I mean, come on. And even if they're asking you to support the ministry, they're not forcing you. No one is choking you. They're saying, this is what we have. And if you feel led, do it. If you don't, no pressure. I mean, I mean, like, that is a concept that just works. Okay. That is a concept that just works. No one is forcing you. No one is forcing you to do anything. No. It's all good. You decide what, if you think we are valuable, we are worth your money, then that's fine. Okay. Now, allowable acquisition cost. So this is a marketing component of lifetime value. So the higher the lifetime value of your customers, the more you can spend to attract new customers. So that, as I was saying, so that for so how that what does it take for you to acquire new customers? If the cost is higher, then the acquisition cost becomes too high. But if the lifetime value of your customer is actually high, there is no problem. There's nothing wrong. There's nothing wrong with it. You can always, because you know that you're going to make your money back, there's no problem. This is why luxury brands such as, Rolex, Tissot, Patek Philippe, Audemars Piguet, all of these brands, the reason why they're okay to spend millions of dollars to advertise in Wimbledon tennis matches, Formula One races, it is because they know that the money is going to come back. The average lifetime value of a Rolex watch owner is a decade. And they're going to give that first Rolex to their sons, and they will grow up into that, similar to Audemars Piguet, to Patek Philippe, to all these luxury brands. They have that incentive because they have mastered to the art of status, status. And we talk about all of these go and watch the value creation videos. We talk about the reason why people buy. That status is one of those reasons. If you are in the luxury brand, the reason why people buy that kind of watch is because they want to show people that they are them. That guy is him, the way they say, oh, that guy is him. Exactly. So that acquisition cost is allowable because the lifetime value of their customers is very high. So I want you to think in your business and see, how can I retain my customers longer? What are other problems that are associated to the problem they have that my current product can solve if we package it differently? If you have a creche business, daycare, parents are looking for all sorts of products. It's not about bringing the kids there to sleep there, to stay there for a whole day and then sleep. They are looking for other things, methods of educating their kids, special need kids. They are looking for toys. There are all sorts of things that you can sell to this one business to increase. What you want is to stretch the lifetime value of the customer. What is the lifetime value of the customer? The amount of time, the longevity, the customers, how long does the customer stays with your business? Okay. And that is how you calculate the allowable, that's what allowable acquisition cost is. So overhead. So these are is the basic ongoing cost to keep your business running. So this could include salary, rent. So keeping overhead low is very important if you're relying on fixed amount of capital. The faster you use it up, the sooner you will need new income. Okay, so cost, there's fixed and variable. So fixed costs exist no matter how much value you create. Variable, they're related to how much value you create. So understanding your cost and how they fluctuate is critical in successfully managing your business. Okay, then there is another concept is incremental degradation. So this is the process of making a business offer worse and worse by trying to cut costs. So saving money doesn't help. If you need to lower the quality of your offering, to do it. So no matter what you do, and we're talking about finance, how do you finance your business? How do you finance your business? How are finances in your business actually the finance affairs in your business should be done? How should they be established? So most people make a mistake of thinking that reducing the cost will bring in more customers. No, what will actually bring in the more customers is the counterintuitive version of that, which is increasing the value. So when you increase the value that you offer, that's how you increase, first of all, you retain the customers and you attract new ones. But if you don't increase the value that you offer, then you're going to fall in the pit of incrementally degradation of your product and services. So no matter what you do, fight up, fight up, fight up, fight up, fight going up. Don't fight going down. Don't play the race to the bottom. And that is the worst game a business can play. I don't care what industry you're in. I know people might say, in trading, in retail, it's different. No, it's not. You might keep the prices where they are, but whatever you do, don't race to the bottom, because that's what leads to business closures. Break even. What is break even? 100% sure you've heard of this. Is the point where your business total revenue exceeds total expenses. Like we were saying, it's not financial sufficiency yet, but you meet break even, you break even on your way to financial sufficiency. Amortization is the process of spreading the cost of a resource investment over its estimated useful life. So amortizing a cost is to distribute the cost. Okay, so let's say if you've acquired a car for 10, 10, I mean, buying things on credit is a way of amortizing the cost, especially if you are acquiring a machine in your business, if you're acquiring an asset in your business that is going to help you to produce. Acquiring it on debt and using debt to acquire it, it's a way of also amortizing the cost of because amortization means to reduce the weight of the burden of that cost on your business. Purchasing power. So this is the sum total of all liquid assets a business has at its disposal. So the money in the bank account, purchasing power. Again, purchasing power for most of us, it means also the capacity that your prospective customer or your niche has to actually afford what you are offering. But it also means, it also can mean the sum total of all liquid assets that your business has at its disposal. Cash flow cycle. So it shows how cash moves in and out of the business. So receivables are money you're owed, or that you are owed, while debt is money you owe to others. To improve cash flow, it's best to collect payments faster and offer less credit. Obviously, that's what you want. That's where you want to be as a business owner. Segregation of duties. So this is a system that helps prevent theft and fraud. So the main idea is to require multiple people to check each other's work. When no one single person handles all parts of a transaction, means authorization, custody, record keeping, reconciliation, it's much harder for mistakes or misconduct to go unnoticed. This is exactly what we do when we are building systems for a business. We make sure that if a payment is issued, who provides the invoice, who approves it, who receives it, who confirms it, those people have to be different. And that segregation of duties, it actually compartmentalize a decision or a process, especially financial processes, so that you don't risk theft or misconduct in your business. Limited also, when you're building these processes, the financial processes in the business for your finance department, we incorporate that. So we show you, okay, this is how we are going to implement segregation of duty or limited authorization in your business. So this is to limit each individual's ability to act in areas that are outside the scope of their responsibilities. And this comes down to when we also, it's not only in finance, but also in logistics, everything that pertains your business interacting with a third party. Could be a client, a partner, a stakeholder. We want to ensure that everyone is operating in their scope, and they're not going to be people who access information they're not. And this is a question that entrepreneurs have asked me a number of times, asking me about the risk of theft in business. And all I say to them is, they don't have to know everything. They just have to know what is happening in their department. And if you've ever worked for any big organization, you know that they master limited authorization, they master segregation of duties, because they understand that there are some information for like junior employees and senior level employees. There are things that they know that the junior employees don't know. So again, Scalability, the biggest, one of the major components of scalability is these processes and systems. When the business has the processes and systems in place, it becomes very easy, because actually the best way to describe a system, systems or processes in your business is it's a code. It's like a software that runs your business. And when I say software, understand it from the viewpoint of instructions, how your company are run, how your company is run, and how your company is conducted and led from those, by those processes, because that's what actually affords you the ability to have these segregation of duties and limited authorization. I mean, most mistakes that happens in growing companies can be mitigated, or the risks can be avoided through having proper processes in place. Opportunity cost. So this is the value you're giving up when you make a decision. We know this. Whenever you invest time, energy, or resources in something, you are implicitly choosing not to invest it in something else. So, you know, if you do one thing, what did you sacrifice to not do it? I'm recording this video. There's something that I could have been doing, but I'm not doing it. So I have allowed myself, I have decided to not have that thing or not be doing that thing for the sake of recording this video. So opportunity cost is also, you can't always look on the upside, you also have to look downside if you follow this given path in the business. And during opportunity cost is one of the things we discuss often in strategy, because when you are solving a problem, there's always trade-offs that you have to make in your business. And these trade-offs, they come in the process of adjusting the business when you're scaling a bit. It's impossible, by the way, just settle this. It's impossible to scale a business without trade-offs. You have to give up some things, and you have to always give up good things for the right thing. You know, every good thing in your business is not right. There are good things that you're doing in your business, but they're not right. And if you want to reach to the next level, then there are things you have to give up and say, you know, I'm not going to do this because for the sake of this. That's what opportunity cost is. And that's fine. By the way, you're going to make some trade-offs, and you will end up discovering that those trade-offs were wrong or untimely. That is absolutely and utterly okay. Don't think that we are not gods. Okay, we make mistakes, and you make mistakes in your business. The only thing you have to understand is make sure that you have calculated those risks and you can afford to make those mistakes. There are some mistakes that are going to come, and you will find yourself in a situation where even the mitigation strategies that were in place could not solve the problem, and it's utterly out of proportion. That I'm happy to say that that is also okay. You will solve it. Everything is figure outable. Everything is figure outable. That's what and that is actually why I believe that the services that we provide is very relevant, because we accompany you on the process of in the process of building and scaling your business. We don't leave you. I always say that what makes our company very unique is that we don't only provide advice, we actually stay, and you hold us accountable on the results of the advice or the strategies we've put in place. You know, because it's also in our interest to have customers that have succeeded. Customer success is a very important and key pillar. It's a key metric in the business. So we want to see customers succeed, not just make money and live. But I digressed. Coming back to opportunity cost, this is trade-offs are part of doing business, because you are always exploring options, and it's impossible to go in all directions at the same time. Time value of money. $1 today is more worth than $1 in the future. Time value of money helps you decide the best way to use your money by comparing different options. The more you can earn by investing that dollar, the more valuable it is right now. With time value of money, you can figure out which choices you give the most benefit and how much time to spend on based on other opportunities. So basically, these are mental models or thinking frameworks that helps an entrepreneur to decide. So these are decision-making tools for entrepreneurs: cost benefit analysis, time value of money. So these are, so you're trying to see, am I going to maximize this investment if I invest now or tomorrow? And this is where cost benefit analysis comes in. This is where opportunity cost comes in, because as a business owner, you also have to be aware of the fact that you don't have all time in the world to decide. And I always say this when it comes also to working with us. So you watch this video, you have a problem in your business, you need the help that we provide, and you say, I'm going to come tomorrow. No, because tomorrow, first of all, the service is going to be surely expensive, and tomorrow is not assured. Tomorrow, the new competition might come in. Tomorrow, something might happen. So the best way to act is now, not tomorrow. Okay, so compounding is when your earnings grow over time by reinvesting them again and again. So it's powerful because even small gains can turn into big results if you give them enough time. So compounding really is a game of waiting. So you invest somewhere, you invest every month, you don't take the earnings, you let the earnings become the reinvestment. So by putting your business earnings back into the business, you can grow your original investment many times over. The key, patience. Compounding rewards those who wait. You have to let the seeds grow. And one of the interesting story I read about Warren Buffett, that was saying how he got richer when, his entire net worth, lifetime net worth was built when he was between 55 to 85, 82. That's when he made the most amount of money. So he'd been investing for 50 years or 45 years or 30 years, and he made obscene amount of money in a very short period of time because of that patience, because he let the compounds, the compounding, do their own job. But in terms of business, even beside investing, is that, so you see that you don't take all the earnings, and that's where when we're talking about business sufficiency, financial sufficiency of your business, part of the upside of your business being financially sufficient is that you have the ability to take those earnings and then reinvest them back in the business. So compounding, leverage. So leverage is the practice of using borrowed money to magnify potential gains. If you have an investment that promises to double, you can make 10x if you borrow money and make that investment 5 times. Now, leverage is not only capital. This is leverage explained from a finance perspective. Leverage can also be technology. Leverage can be people. Leverage can be machinery, which is technology. So leverage is anything that is going to allow you to get a limited amount of input and then have outsized return. So so technology is leverage. I'm recording this video, but this video is going to be watched by many people, multiple people. But I don't need to record multiple videos for multiple people to watch it. I just have to reproduce it once, one time, and then technology becomes my lever. So I push it and then it pulls the numbers. So leverage is that. So what is here in business, you need to understand what is your leverage. Is your leverage a personal brand? A personal brand can be a leverage, because if you have a number of people that follows your work, you can raise money from there. You can acquire clients. You can get stakeholders. Is your leverage capital? Have you built good credit that the banks can actually lend you money with ease? Have you built actually customer relationship? Speaking of customer relationship, is actually one of the most underrated leverages, because once the customers have built that loyalty, you've built that loyalty over time, then it becomes very easy for them to become your lever, because you always know that whatever you produce, because they believe in you, when you bring it to the marketplace, people are actually going to go ahead and buy it, because first of all, you know them, they know you, they trust you, you trust them. So that's also another form of leverage. Okay, so leverage is that thing that gives you an unfair advantage. Bootstrapping. This is the art of building and scaling and operating a business without outside funding. If you're watching this video, you've probably bootstrapped something, 100% sure. I'm sure you've, started a business on your own. That's what bootstrapping means. When investors ask you, oh, have you bootstrapped this? If you built it for you will hear investors asking these questions. So this is what they mean. Return on investment is the value created from an investment over time or resources. You invested $500, you have gained 750. So the return on investment was 50%, $250. Okay. Sunk costs, very important. So sunk costs are investment of time and energy and resources that can be recovered once they are made. Continuing to invest in a project to recoup lost resources doesn't make sense. Throwing good money after bad, it is not a winning strategy. I've seen this happening over and over again. And it has a fallacy that also is attached to this concept. This concept has a fallacy called sunk cost fallacy. Sunk cost fallacy is when an entrepreneur, or sunk costs, is when an entrepreneur can clearly see that the product is not working, but they have fallen in love with the idea. They don't want to change, they don't want to adapt, and they keep investing. I don't care if you say, I'm not investing money, but you're investing time. Time can be equal to money. So you're investing your time, you're investing your energy in something that you can clearly see that it doesn't work. But for some reasons, you think that if you keep investing in, it's like saying, I've gone too far to come back. No, there is no such thing in life. You can always come back. I don't care if you've been doing that business for 10 years. You have to have the humility to accept that you were wrong. There are businesses that I've started, when I look back, I skip a breath, because I'm like, how did you what you thought that is going to work? And I'm like, when I look at that and I speak to my past self, I say, you did not know any better. And that's fine. That's okay. Like, it's normal. Again, something that I need entrepreneurs to understand is to do not lose in touch with your humanity. We are human beings. We make mistakes, and that is fine. The problem is not making mistakes. We are prone to making errors. The problem is when you think that you are not supposed to make mistakes. You're going to make mistakes, but the way you handle them and the way you perceive an error when you make it, that's what makes a difference. So if you see that something is wrong, that a project is not working, change the project, pivot, or change the approach, but do something. By all means, do something. So this is something to be aware of. So I want you to assess your business and see, are there things that you should be changing? Are there things that you should be dropping? Are there customers that you should, by the way, we should also normalize to let customers go, to fire customers. You say, we've been working together for, this amount of time. I appreciate doing business with you, but I believe that this is the best time for us to part ways, because we've done well, but we can no longer accommodate your needs. And that's totally fine. It's normal, it's fine, but don't suffer this fallacy as a business owner. If you had a chance to watch this video. Internal controls. So these are a set of specific standards or SOPs a business uses to collect accurate data, keep the business running smoothly, and spot trouble instantly. This is why SOPs are very important. And these internal controls, these are some of the mechanisms we put in place. By the way, I think the essence of the work that we do for businesses is really to put in place a software. It might not be a literal software, but it's a set of instructions that runs your business. For instance, an example of internal control could be, we have to do monthly check-in with the CFO to see if there are any irregularities in our finances, or to see if there are any challenges that they're facing. Or it could be, we are going to now start doing audits every 3 to 6 months to make sure that nothing is irregular, everything is in order. So those are internal controls that you can put in place in your business to ensure that the business is moving well, things are moving seamlessly, and there are no challenges that needs to be solved that people have not spotted yet. So internal controls, it's impossible to have internal controls without SOPs, because SOPs are those instructions, and those instructions tells you exactly what to change, when to do it, how to do it, for to limit those again, like I always say, to solve issues before they become problems. Okay. Now, I know these were, these are a lot of terms. So I want you to go back in this video and, watch it with enough time. Write down, take a note and paper and write down. Say, okay, how does this principle apply in my business? Because it's not about, again, our markers at the marketplace. There's an idea I thought about when, this morning, I was like, the measure of a great entrepreneur, or the success of every entrepreneur, or the success of every business professional, is actually not about, they say the degrees, the companies you've consulted, the hours you've consulted. No, the ultimate metric is the businesses that you've built, the customers that you've helped, the results that you've produced. Everything else is a means to that end. So this video is a means to an end. This video is the means, which is teaching you this, but the end is for you to know, how does what is the balance sheet of my business? Can I read it? Go and tell your accountant to give you a balance sheet. Opportunity cost. How am I leveraging this in my business? Cost benefit analysis. Break even. Have we broken even? When did we break even? So it's not about taking these concepts because that is not going to serve you. So I want you to go back and learn them and see how they apply in your business, and start, let them become your everyday life. They should not be some foreign concepts that you randomly know that are in your brain. So they are there to actually help you in your business day to day. These are the things that you're going to hear either today or tomorrow in your business with investors or with partners or stakeholders. So with that being said, I hope this video was provided some level of value to your business, and I'm looking forward to seeing you in the next one. Ciao.